Good morning and welcome to the Orlando Real Estate Buzz. Joseph Dion of Appley Home Mortgage, and I'm Brendan with the Homes in Orlando team, and coming to you with all the news, both nationally and local, that affects the real estate market. And we have a couple big things that came out past couple days. Number one, Consumer Price Index. That one hurt you a little bit, huh, Joe?
That would hurt. But you know what's interesting? We're rebounding pretty decently right now. Not quite. We've seen a little bit of a rebound yesterday, and today we're up 20-something basis points so far based off of retail sales news.
Interesting. And then we've got continued warnings about the commercial real estate. People coming out saying we've got a bubble. So we're going to get into a little bit of that further today. And then we got our local numbers as well. So let's start off with the Consumer Price Index. It came out and it was a little hot for what everybody wanted.
It was I would definitely say that. Core inflation.
People were expecting what, 2.9?
Mm-hmm.
We came in at 3.1.
Yep.
And when we go in and we break down the numbers, we see a couple big things. And number one is our shelter again.
Yep.
Even though we're seeing, downward pressure on rentals, it's still coming through at 6%. So I'm thinking, what could be fueling that? I'm wondering if, and this is something I'm not positive of, is home insurance in here as well for the rentals possibly?
I don't know.
It's pushing it up.
I don't think it is, but I think where you kind of go into is what states and where people are moving and opportunities, right? And you take a look, and maybe some of this is like look at Florida. There's no rent control, right?
Mm-hmm. Sure.
So rent can kind of just go up if it needs to, and if there happens to be demand and shortage, just kind of keeping it high. I don't know.
I've read some local, numbers on the rentals, and it's either flat or down a little bit, down about, maybe 0.4%, which isn't a whole heck of a lot.
Yeah.
But even if it's flat, I would expect this number to start shrinking a little bit,
Yeah.
But it's not. It's consistently over the past several months been right in that 5-6% area. And then the big one that really kind of kicked everybody was our transportation services costs.
Yep.
And I think, you and I talked about before, even though, gas prices were down a little bit, fuel costs were down a little bit, what's been going up with everything?
Insurance.
My gosh, I saw a reel for this dad who was going through his car insurance, and it was him, his wife, and 2 kids, and it was almost as much as his mortgage payment.
Yeah.
And he's like, I may stop driving and just get an Uber. It'd be cheaper.
Yeah. Well, and I was looking up this, within this, the motor vehicle insurance, like auto insurance, according to all of this, and I saw a report, Barry Habib kind of said this, it's roughly 3.6% of the core inflation reading. Like, that's a significant amount to play into. And I didn't know it was I knew it was important. I didn't know it was that weighty, right? Wow. But it makes sense.
I didn't realize that, because you look at that and then you see, because we had some good relief at the pump, the past month or so. So you look at that and they were down 14.2%. And it's like, man, there's really some things pushing up. And of course, shelter contributes roughly about 30% to that number. So as long as that shelter number continues to stay high, these other ones can show, reductions. But when you've got a third of it pulling you up all the time, that number is just going to continuously stay high.
Yep. There's not much you can do with that, right?
Yep. There isn't. And then how does it affect you? Well, your 10-year treasury reacts.
Mm-hmm.
And how's it usually react?
Not in a good way. It goes up,
Yeah.
which means MBS goes down. Like,
Yeah. Because we were sitting around what, 4.1.
yeah.
The report came out, and we jumped to roughly what,
4.27,
4.3. Yeah.
almost 4.3. By the end of the day, that day after the core, like we were 4.27. Like, that's a
Yep.
big jump. Like, that's a big movement on one day.
Yep. Yep. And it's just, to me, it's just another shot across the bow of, all these people who keep saying, we're going to have, rate decreases.
Mm-hmm.
But, the thing that we watch on a regular basis, and we put this up pretty much every single week, is tracking the Fed watch. And in March right now, we've jumped. You look a week ago, 81% of the people said they thought we were going to get a rate cut in March. And we've now gone to roughly 89%. So people really are, you got that 10%. I'm not sure what they're looking at, that they think that we're going to get a rate cut in March.
They're just holding out, right? Like, they're just hoping to be optimistic. Like,
if I was in Vegas, I'm not putting the money on it. That's for sure.
no.
Not at all. And then when we go to May, you're seeing something very similar, in that you still got a lot of people holding out that May is going to be our first rate cut. But it is down from a week ago. You had 40% thinking no rate cut, and went to 61, and we're holding right now about 59% that we're not going to have a rate cut.
Yeah.
I mean, even in May. And I think you and I both agree we're thinking June.
I think June, and I think we can get into March, and I may kick the can further down on the first one. Like, I'm really curious to see March's numbers, because I think the Feds are going to be more conservative when it comes to this rate cut.
Yeah, I know, Powell's mentioned it before. He doesn't want to see something happen that like happened in the 80s, where the Fed raised, got too aggressive in the cuts. They started the inflation down, but the minute they started the cuts, what happened? Inflation shot back up, and they had to really crush everything.
Yeah.
And I know he doesn't want to have to do that. And quite honestly, as long as the federal government keeps spending at the pace they're spending, I don't see how he drops it. I really don't, because $2 trillion a year in deficit. $2 trillion. Yeah. Yeah. $2 trillion a year. I mean, you're creating money. The Fed doesn't have to print, because we're just creating bonds, and it's creating money. Mm-hmm. And you take that out, our GDP drops like 3 or 4%. We're actually a negative GDP if we take that out, or a flat at all. Great Britain and Japan just basically came out this morning and said we're in recessions.
Yeah, I'm shocked it took them that long to hold. They held out. They held out as long as possible.
Germany's contracting right now. Mm-hmm. So you've got, what is it? 3 of the top 5 economies right now are in a recession. Mm-hmm. And I don't care what China says. China's in a world of hurt. I would not want to be anywhere in any of the government agencies over there, because I don't know what they do to them. They kind of disappear sometimes. So that's just something I just don't want to touch at all. Mm-hmm. So we're looking at all this, and then we're getting the same warnings that we've been getting for the past, year on the commercial real estate. And this is something I didn't know. I really like this website. He does a great job doing research and bringing out some things that other people miss. But there's 4.7 trillion in commercial real estate debt right now.
That's due.
That's the total.
That's the total. Okay.
But instead of only having 659 billion, just 659 billion due this in 2024, It's ballooned to 929 billion.
Yep.
And do you know why?
Previous notes being just pushing debt off.
Yes, modifications.
Yeah. Okay.
Modification.
So why would we want to modify? Let's think about this, right?
Yep.
Why would a bank want to modify?
Because they don't want to take it back.
And they don't want to take it back. Why?
Because it's worth less than what they wrote the notes for.
Yeah. So it's kind of like, think about it, right? Like, it's like a short sale in residential, right? If they take it back, right? Like there's like stuff like they don't want to do stuff like that, right? It's a foreclosure, and it's much harder to get rid of a commercial building, like a 20 million, 50 million, 100 million commercial building than it is to get rid of a single family home.
Yep.
Right. So, and I think that's what we're running into here is like, they're kind of like, hey, like they're still paying us. Like we're going to extend the note and we're going to still get something.
And when they extend them, you think about it, what the cost of their money is to what the cost, if they're keeping them at the same interest rates.
Yeah.
The banks are losing money on the modifications.
Yep.
How long can they hold those modifications without forcing the refinances?
Yeah. And I think it's just that, like, they don't have the revenue. These commercial properties don't have the revenue that's needed to justify the expenses. The loans are way more than the buildings are worth right now. Like there's so much challenge on this. It's kind of like, hey, like we'll take something versus nothing, because if we refinance to where rates are today, they wouldn't be able to get it approved.
No. And this was interesting. This was from iConnections. And this is Barry Sternlich. He is the CEO of Starwood Capital. And this is what he had to say last week.
I don't hear anything.
Oh.
Do we have an audio coming?
You can't hear it?
Nope, I can't hear any audio on my side.
Okay. So, it's playing my...
So all right, well, let's cover this, right? So first off, Starwood Capital Group, they're like what? Investment firm with like 120 billion, something 100 billion, something like that in assets?
Yes.
So guy knows what he's doing a little bit.
Oh, yeah. Yeah, he's on it. And his basic gist was that we have $3 trillion. He had 3 trillion as his number worth of commercial real estate. That's really only worth $1.8 trillion.
Okay.
That's it. It's only worth 1.8.
That's a big haircut.
That's a huge haircut. But the other interesting thing he brought up was that the United States is the only country that hasn't gone back to the office since the pandemic.
Okay.
Japan's commercial vacancy rate is like 0.1. South Korea's, he said, was like 0.2. England, Germany, same thing, very low vacancy rate in the commercials industry, in the commercial residential real estate market. We are actually the only country that hasn't done that.
Why would that be? Like, I don't understand why that would be. Is it like, I feel like maybe, I don't know, like, does public transit, opportunities to get places, ease of access? Is it the fact that we have our home bases have so much and resources? Like, are those the things that play into this?
I don't know. I think it could be a part of it. I think another part of it was the job market. Is in order to get someone, the job market was so strong that the employee could say to the employer, hey, yeah, I'll work for you, but I want to work from home. Or I want to be able to come, I want to be able to stay home 3 to 4 days a week, come to the office maybe 1 day or 2 days or 3 days a week. And I think maybe that was a portion of it, a good portion of it. And another portion could just be that we're soft. Employers are afraid to stand up and say, no, you've got to come to the office.
Mm-hmm. Yeah, I
You know,
mean,
IBM came out, and he mentions this is that IBM came out and said you're coming back to the office. You know, no more of this. You're coming back to the office.
mm-hmm.
You know, and it's interesting because it's kind of a double-edged sword because you've got all this commercial vacancy. I saw a graph the other day that if you stacked it all in a certain size building, it would be like 3.5 miles high, something like that. There's that much vacancy in the United States.
Yeah.
And but you've got this vacancy. So if people go back, but then you've got all these remote workers like in Boise, Idaho,
Mm-hmm.
move to Boise, Idaho because they had the flexibility of working from home and they get called back to the office. This gets in better shape. The housing market starts to fall.
Yeah.
Because all of a sudden you get all these people who have to go back.
Well,
And
it falls
houses
regionally, right?
Yeah. I mean, you're going to see some. It'd be interesting to see some. Regionally, you may see prices dropping 20%, where other areas it's going up 20% because you got to move people back.
Mm-hmm. That'll be interesting. That would be very, very interesting.
Yeah.
And you see, like I mean, I've heard like Google has put a heavy emphasis back in office, right? Of different pieces. And what I found, and I was talking to a buddy that works for not Google, but works for another IT company, and he basically was just like, hey, like where they were based and where he was based was 1,000 miles away. And he's like, hey, like you guys hired me as a remote person. Now you're telling me I need to come into the office. Like, what do I do? And they're like, oh, well, like we'll have you come in 1 week a month versus weekly. And he was like, great, awesome. And then what he found is all of a sudden his role is starting to diminish. And he was just like, wait a minute, like I'm almost being forced, like he's being put into a force where he knows like he's, in the tech sector, he knows he's being put in a position to where they're basically trying to make him obsolete and eliminate him without him basically forcing him of like, hey, there's no growth, there's no opportunity, there's no nothing. Like you're stuck. You're going to do this. You're going to operate in this very rudimentary level, right? That's not what you wanted, not what you're hired to do. And we're going to let you live there. But the goal is that we're hoping that you leave, right? Like that's what he feels like. And I think that's what you're going to start seeing some of these bigger companies do is like, hey, like, oh yeah, we did hire you, but they're going to try to fade people away or fade people out to get back that in-office approach.
Yep.
And if you're not willing to conform, you might find yourself stuck in that situation. But he was like, I've got 3 kids. I've got a wife. She's got a job. Where, like, I can't just pick up and move our family over there.
Yep. And it's an interesting situation because, I mean, as a company, and I'm looking at all these leases I have, and it's just basically losing money. Productivity wise, I can't tell you is one better than the other. I mean, I look at our industries. I was at your office the other day. You've got a beautiful facility, but do most of the people come in every single day? No. It's like as a real estate agent, I love my office at home. I've got a nice office over in Tuscaloosa, but I honestly don't feel like driving a half an hour to go to Tuscaloosa. It's like that's too far for me. And I can just get up, go to my office, and start doing my work.
But not everybody's built like that, and not every role is built like that, right? Like some roles, like I hate to say it, like I've had employees in the past where if you don't have a constant eye, they're great employees, but they need someone watching over them to make sure when they're not like, because they may sit there and go, oh, well, my job task is A, B, C, and D. And you're like, yeah, but like if you get through A, B, C, and D, there's also E and F that you can do, but they'll sit there at D and go, okay, well, I'm done. And they'll just, if they're at home, they'll be like, well, I'm going to go do some laundry. I'll clean the house. I'll go run an errand. I'll do this. And all of a sudden I need them. And they're like, oh, well, I'm in the middle of something. And I was like, you're not at your house, are you? And they're like, no, I went to the doctor's. And I'm like, okay, cool. I'm not paying you to go to the doctor's. Like you're on my time right now, whether you're at your house or not. Like I'm paying you right now not to go run errands And that's the challenge sometimes. And I think that's where the work remote, I think that's where a lot of employers are struggling with the work remote to in office, is they saw the initial productivity went up, like happiness went up, people were excited. Yep. But then I think people got more and more complacent and productivity has gone down in certain areas. So
I could see that. I could definitely see that. I could definitely see that.
You know, I think that's maybe where an employee may, and this is I don't know what's the right way to say it. The employee that works remote may sit there and say, here's everything that I think I'm supposed to do, right? Here's my 10 tasks. They'll never do task 11 through 15 when they work remote. Yeah. Because they go, well, my job sheet says this. But when someone's in office, you have the ability to do task 11 through 15 because when they're not busy with the original 10 tasks, they're working on these other tasks or they're learning new skills, and they're not learning those new skills when they work remote. Because once they're remote, when they're done, they're done. So now you're not able to train people up to grow in other areas to get job tasks. So now you've got to hire another person to do 11 through 15. When before you might have had 3 people that did 1 through 10, and those 4 people could do 11 through 15 amongst each other.
Yeah. Makes perfect sense. It's definitely, it's going to be a challenge going forward for everybody.
Yeah.
And, you know, just some of these things that are coming with the commercial real estate just kind of enlightens, you know, these discussions up a little bit. So
absolutely. I just wish we were in an industry that I can go 4-day work schedules. Just like, let me hire, like I can tell all my employees, you can work, 10-hour shifts Monday through Thursday. I wish I can give everybody Fridays off.
Yeah.
I'm pretty sure every realtor will hate me.
Yeah. Well, let's hop into our numbers for the week.
All right.
So
anything good?
We dropped off a little bit.
Sure.
274, which makes sense, middle of the month.
Yep.
Inventory dropped a little bit, but we're holding steady for the single family homes. Our condos are still in the doldrums at 112. And our inventory just continues to go up in the condo market.
Yeah.
And then we get into our numbers that we look at every week, which is the original list to sales price. This actually did jump up about 1%.
Okay.
Which could be, again, because we have better rates, more people out, more people shopping overall.
Maybe. Yep.
But this was something I usually glance over this, but I saw this today and it just kind of blew my mind in 2 spots. And that's months of inventory. That's basically you take how many listings, how many sales, you divide it and you get how many months. Look at over $1 million right now for single family homes. We have 11 months supply. 11 months.
With rates where they are, it's just really hard to justify. And with home values, like that's the other thing. Like, I'm going to be honest with you, like $1 million doesn't get you what you thought it would get you.
No, not at all anymore. I mean, you walk in and you're like, this is $1 million home. Like, no.
You're like, I got to redo this. Like, I used to joke. I was like, if you were buying a $500,000 home, you were walking in that $500,000 home being like, this is going to be at least 5 bedrooms, at least 3 baths. It's going to be fully renovated, completely up to date. It's going to have the pool. It's going to be great. Right now, it's like you go to the million, you're 5'3" and needs to be updated.
Yeah. There's a lot of them that need to be updated. It's nuts. But then again, look at how much they're discounting. Close to over $100,000 on average.
Wow.
That's some big price cuts.
That's big. Yeah.
Yeah. Then we look at everything graphically, you see we've really, kind of just flattened out as far as median values, median prices. We're not seeing those price increases that a lot of people, that you see in the news. Oh, prices went up 6%. It's like, really, we're really kind of flat. Overall, we've been flat for several months. I'd say really since last July, prices have been kind of flat overall. Average days on market, we came down a little bit. Beginning of the year, people excited, want to buy a house. Rates were, half a point, 3/4 of a point better overall. makes it easier. And you see our inventory's kind of flattened out. Then we hop into our condos, and you see here again, we're roughly 95%. They're giving some big discounts.
Big discounts.
But again, I looked at the months of inventory, and look at between 500,000 and $1 million. 17 months of inventory.
17 months. Wow.
17 months. That's a total market.
Yeah.
I mean, that's bad.
A hard market to be in right there. Whew.
That's a very tough market to be in right there. And then again, this one's always interesting because you get one good sale and boom, this pops up, this pops down.
Yep.
But our period average really since October has sat at roughly 108, where this should be sitting, 250 to 300.
Yeah.
In a normal market, it should be sitting high.
Yeah. Yeah, we've definitely seen a softening of the market, right? Like there's no way around that, right? Inventory is going up. It is true blue, like it is a buyer's market right now.
Oh yeah.
But the crazy part is what a lot of people don't think about too is like if you're still selling, like then you I was talking to somebody that wanted to list and buy, and they're like, oh my gosh, it's like I'm gonna have to give concessions to this and that. And I'm sitting here going, you gained 40% equity in 3 years.
Yes.
Like you're still winning.
Yeah. And it's a lot of people just look at things and they're like, well, I want to list it here. Well, the value's here.
Yeah.
But I want to list it here. But the value's here. It's not going to sell there. You're just going to let it sit on the market. And we're going to have to do price reductions to get it down to where it actually where its actual value is. And it's a question I always ask is like, okay, do you want to own it or do you want to sell it? Which one is it? Because if we do it here, you can continue to own it. If we do it here, you're going to sell it. And you just, that's where you just got to, tighten your numbers up and make sure you're pricing it correctly. Because you'll see houses that are priced correctly, presented correctly, sell. They will still sell. 30-day window right now, they'll sell. But if they're not, if they're overpriced, people are smart. People do their research. And they're just if they don't feel it, if it doesn't feel right, they're not going to do it. They're just not going to do it at all. So those are our numbers for the week. Thank you so much, Joe, for joining us. As always, please like, subscribe, and join us every week here as we go through all the news that affects the housing market.
Bam.